What if I told you there's an ETF that doesn't just keep up with inflation, but could actually pay you every single month? And it's probably not the one you hear about most often. With over 12,000 ETFs out there, it's easy to feel lost in the crowd. That's why today, I'm zeroing in on the one ETF I'd pick for reliable dividends, and the one for maximum income, no fluff. First, I'll show you a dividend growth gem that can help your payouts grow year after year. Then, we'll look at a high-income play designed to pay you monthly, even in flat markets. If you want a clear, actionable answer for your 2025 investing goal, you're in the right place. But before we get to those targeted strategies, let's talk about why building your foundation with a broad market ETF is so important. Owning a broad slice of the market with just one investment is one of the simplest ways to get started and to stay invested for the long haul. That's where broad market ETFs come in. Instead of sorting through endless stock picks or worrying about which industry will outperform next, you can own hundreds of companies in a single move. This approach gives you instant diversification, spreading your risk across different sectors and companies. If one area of the market struggles, others often pick up the slack, keeping your portfolio on steadier ground. For most investors, this kind of broad exposure is the cornerstone of a resilient portfolio. Take Vanguard's S&P 500 ETF, known as VOO. With VOO, you get exposure to 500 of the largest and most influential U.S. companies. It's a straightforward way to tap into the core of American economy. Tech giants, healthcare leaders, financial powerhouses, and more, all bundled together. The best part? VOO keeps cost incredibly low with an expense ratio of just 0.03%. That means more of your money stays invested and working for you instead of getting eaten up by fees. For many investors, myself included, VOO is a set-and-forget option, reliable, consistent, and requiring almost no maintenance. But what if you want to look beyond the US? Vanguard's Total World Stock ETF, or VT, lets you do just that. VT adds 9,000 global stocks for extra diversification, but often underperforms VOO's US focus. The decision between those two comes down to your personal outlook. If you believe in the continued strength of American companies, VOO keeps things simple and focused. If you want a stake in markets around the world, VT gives you that broader reach, though it may come with slower growth. The real advantage of building your foundation with a broad market ETF like VOO or VT is how it balances risk and return without demanding constant attention. You're not chasing trends or guessing which company will win next. Instead, you're investing in the long-term growth of established businesses, either just in the US or around the globe. This approach has stood the test of time, delivering solid returns for patient investors. Of course, sticking with the broad market isn't the only way to grow your wealth. Some investors want more than just steady, market-matching returns. They're looking for something that can outpace the average, even if it means taking on a bit more risk. That's where growth-focused ETFs come into play. For investors who want to push beyond steady, market-matching returns, growth investing offers a different path, one that chases higher potential rewards by focusing on companies expected to expand faster than the average. This strategy is built for those who are comfortable with risk and have a longer time horizon. Growth investing targets businesses leading in innovation, rapidly increasing their revenues, or capturing new markets. The upside? Your portfolio could outpace the broader market. The trade-off? Expect big swings with that upside. When it comes to growth ETFs, one fund consistently stands out: Charles Schwab's U.S. Large Cap Growth ETF, or SCHG. This ETF zeroes in on high-quality growth stocks, aiming for capital appreciation rather than immediate income. SCHG's performance is hard to ignore. Over the last 5 years, it's delivered annualized returns of more than 17%. Over the past decade, it's averaged over 15% per year. That's a remarkable track record, especially for an ETF competing against the S&P 500, a benchmark that's notoriously tough to beat. SCHG achieves this by concentrating on some of the most influential tech companies in the world. Its top holdings include Apple, Microsoft, Nvidia, Amazon, Meta Platforms, and Broadcom. These are the names driving innovation and shaping entire industries. The ETF invests in 229 companies overall, but its portfolio is heavily tilted toward technology. This focus is what powers those strong returns, but it also means SCHG's performance is closely tied to the tech sector's fortunes. If tech is booming, your returns could soar. If the sector hits turbulence, expect your portfolio to feel it. The expense ratio for SCHG is just 0.04%, making it one of the most cost-effective ways to access a basket of top growth stocks. Low fees matter. A fraction of a percent saved each year can add up to thousands of dollars over decades. With SCHG, you keep more of your gains, letting compounding work to your advantage. It's important to know what you're getting and what you're not. SCHG isn't designed for investors who want regular income. Its dividend yield sits around 0.4%, which is modest compared to broad market or dividend-focused funds. Most of the companies in SCHG reinvest their profits to fuel further growth. So if you want your investments to pay you now, this ETF may not fit your needs. But if you're focused on long-term capital appreciation and can handle volatility, SCHG is a compelling option. Because SCHG is so tech-heavy, its returns can be dramatic, both on the upside and the downside. This is a fund for investors who are comfortable with the ride and can stick with their plan through market cycles. It's not the right fit for everyone, especially if your main goal is to build a portfolio that generates steady, growing income. That's why, even though SCHG is a strong performer and a core part of my own growth strategy, it's not my top pick for those aiming to maximize passive income in 2025. SCHG crushes the market on growth, but its minimal dividends mean it's better suited for investors willing to prioritize future wealth over current cash flow. If your primary goal is to see your income grow and keep pace with inflation year after year, there's a different ETF that deserves the spotlight. What if your investments didn't just pay you, but also gave you a raise every year, helping to keep up with inflation while building wealth over time? Meet Sarah. She's 30, and her goal is to build a Roth IRA that will support her early retirement, not just with steady income, but with payouts that increase over time. For Sarah, reliable growth in her dividends is the key to staying ahead of inflation and securing long-term wealth. That's where dividend growth investing comes in. Dividend growth investing centers on companies that not only pay dividends, but have a proven record of increasing those payouts year after year. This approach is less about chasing the highest yield today and more about building a stream of income that grows steadily, compounding over decades. For someone like Sarah, it's the difference between collecting the same paycheck every year and getting a raise that keeps up with the rising cost of living. For 2025, one ETF stands out for this strategy: the iShares Core Dividend Growth ETF, or DGRO. DGRO is built specifically for investors who want both reliability and growth in their dividend income. It screens for U.S. companies that have increased their dividends for at least 5 consecutive years, ensuring that only businesses with a strong commitment to shareholder returns make the cut. This focus on consistent dividend growth helps investors like Sarah build a foundation for compounding wealth. DGRO yields about 2.2% today and holds 408 companies that meet its strict growth criteria. Its expense ratio is just 0.08%, keeping costs low and allowing more of your money to stay invested. Over the past 5 years, DGRO has delivered annualized returns of roughly 16%, and over the last decade, it's averaged more than 11% per year. These numbers highlight why DGRO is a favorite among dividend growth investors looking for a balance between income and long-term appreciation. Now here's where the Roth IRA comes into play. If you hold DGRO in a Roth IRA, every dividend you receive and every bit of growth is shielded from taxes, not just today, but for the rest of your life. This tax advantage means Sarah's reinvested dividends can snowball without the IRS taking a cut, maximizing the compounding effect. Over years and decades, this can make a significant difference in the size of her nest egg and the amount of income she can draw in retirement. It's also worth noting how DGRUP stacks up against other popular dividend ETFs. While SCHD, the Schwab US Dividend Equity ETF, offers a slightly higher initial yield, DGRO's focus on 5 consecutive years of dividend growth makes it especially well suited for compounding dividends in a Roth IRA. The emphasis on sustained increases rather than just current yield gives DGRO a unique edge for long-term investors who want their income to keep growing. Looking inside DGRO, you'll find a portfolio that's both diversified and focused on quality. Financials and technology make up the largest slices of the fund, with major holdings like Microsoft, JP Morgan Chase, Broadcom, ExxonMobil, Johnson & Johnson, and Apple. These are established, blue-chip companies known for raising dividends through different market cycles. DGRO also spreads its investments across healthcare, industrials, and consumer staples, helping to cushion the portfolio against sector-specific downturns. With more than 400 holdings, DGRO avoids concentration risk and provides exposure to a wide range of businesses. These aren't speculative bets. They're established leaders with a track record of rewarding shareholders. For someone like Sarah, this means less worry about any single company derailing her income plan. The low expense ratio of 0.08% keeps ongoing costs to a minimum, which is crucial for long-term investors. Lower fees mean more of your returns stay in your account, compounding year after year. Over time, even small differences in expenses can add up to thousands of dollars. DGRO's historical performance speaks for itself. Over the last 5 years, it's returned over 16% annually and more than 11% per year for the past decade. While past results don't guarantee future performance, this track record shows DGRO's ability to balance growth and stability, a combination that's hard to find in a single fund. For investors like Sarah, who want to build a growing income stream, DGRO offers a practical, low-maintenance solution. Its blending of rising dividends, strong diversification, and tax efficiency in a Roth IRA make it a compelling choice for anyone focused on long-term financial independence. Of course, not every investor is content with a 2.2% yield, even if it grows over time. Some want to maximize income right now, even if it comes with added risk and potential trade-offs. There's a different approach for those willing to take that step, and it's changing the way many think about generating high yields from ETFs. For investors focused on generating the highest possible monthly income, covered call ETFs have become a popular solution. These funds use a straightforward approach. They own a broad basket of stocks and repeatedly sell call options on them, collecting premiums that are paid out to shareholders as income. This strategy works best in flat or slightly volatile markets where the consistent income from selling options can smooth out returns, even if the underlying stocks don't move much. The trade-off is that your upside is limited. If the market rallies, the ETF gives up some gains in exchange for those regular payouts. Still, for anyone prioritizing income over maximum growth, the appeal is clear. Let's look at one of the most compelling examples on the market right now: the NEOS Investments NASDAQ 100 High Income ETF, or QQQI. QQQI mirrors the holdings of the well-known QQQ ETF, giving you exposure to 100 of the biggest names in tech: Apple, Nvidia, Microsoft, Amazon, Broadcom, and more. But unlike QQQ, QQQI layers on covered call strategy across all these stocks, generating a dividend yield that's currently approaching 14%. That's a huge leap compared to the 1 to 3% yields you'll find with most broad market ETFs. And the best part? QQQI pays that income out monthly, making it a standout for anyone who wants steady, predictable cash flow. The fund hasn't gone unnoticed. QQQI recently won ETF.com's award for Best Active ETF, a significant recognition in a crowded field. It's an endorsement of both its management and its ability to deliver on its income promise. Despite its active, income-focused approach, QQQI manages to keep cost in check with a 0.68% expense ratio. For a strategy that requires constant management and monthly distributions, that's a reasonable fee. Of course, there's a key risk to keep in mind. QQQI's heavy tech weighting means your returns will be closely tied to the ups and downs of major technology stocks. It's a fund best used as part of a diversified portfolio, not as your sole holding. If you're looking for even higher income and are comfortable taking on serious risk, there's an ETF that pushes the boundaries even further. The YieldMax MSTR Option Income Strategy ETF, or MISTI. MISTI is an honorable mention for those who want to chase ultra-high yields, with a distribution rate well over 100%. This is achieved through a highly complex option-based strategy that's far more volatile than typical covered call funds. MISTI's monthly payouts can swing dramatically, and the fund's expense ratio is 0.99%, reflecting the intensive management required. The performance has been exceptional in recent periods, but the risks are equally extreme. MISTI is only appropriate for the riskiest slice of your portfolio, if at all. In summary, covered call ETFs like QQQI offer a way to boost your monthly income far beyond what traditional stock or bond funds provide, but they come with clear trade-offs. You're sacrificing some long-term growth potential for the sake of steady cash flow, and you need to be comfortable with the sector concentration and the mechanics of options. For most investors seeking high, consistent income with manageable risk, QQQI is the pick that stands out. If you're considering something even more aggressive, like MISTI, make sure you fully understand both the complexity and the volatility that come with it. Choosing the right ETF for your portfolio means weighing your appetite risk, your need for income, and your long-term goals. Each of these funds serves a different purpose, and the best choice is always the one that fits your personal strategy. In 2025, your ETF choice should match your specific goal. If you want dividends that grow and keep up with inflation, DGRO is the standout pick. For those seeking high monthly payouts, QQQI delivers strong income, while MISTI is an option for those comfortable with much higher risk and ultra-high yields. Which of these fits your goal for next year? Comment growth or income below, and let me know your pick for one ETF in 2025. Remember, the best ETF is the one aligned to your own goals and risk tolerance, not the one everyone else is buying. See you in the next video.